Hello.
Hello. What's up, Logan?
Not much, just got my coffee, just hanging out.
Awesome, awesome. Let me co-host you, and then you can share screen. It'll be a nice, small, intimate class. So, guys, if
Yeah.
you got questions, make sure to ask them.
Let's see, make sure everything's going good. I'm actually going to be sharing my screen with Excel today because it's going to be the easiest way to demonstrate really how spreads work. Especially because I'm not really going to go over when to trade credit spreads, like in the market. I'm going to go over more of how to trade them, what they are, how you can make money using them, and just kind of the basics of it because it's really complicated. It's a lot to wrap your head around at first, but we'll figure it out together. All right. So let's see. Let me get a couple of things set up right here. All right, and feel free to ask questions to start the whole thing, guys. I mean, it's only a few of us in here, so by all means. All right, let's see. All right, we good to go ahead and start, Trent.
Yep, go ahead.
All right, awesome. So, hey everybody, this class is going to be on trading credit spreads, which is a little bit different than most option traders trade. So, most of you will just buy a naked call or put. And we all know if you're buying a naked call or put, you're buying the option to purchase 100 shares of that stock at that strike price or to sell 100 shares. Now, if you're selling an option, which is what we're going to be talking about today, you're doing the exact opposite. So, the easiest way to kind of wrap your head around this at first is we're going to make a quick little table. All right, we're going to have a buy side and a sell side because every transaction has to have a buyer and a seller. So, let's say we're trading Apple. It's a um, let's say Apple's trading at $100 and you want to buy a 1 cent call and the strike price is, oh, sorry, the strike's 110. The premium you pay is, let's just say 1.1 and it expires, let's say next week, just for easeability. Okay. So here's the contract. We're going to do a quick cash flow for each buy and sell. So if you're on the buy side, you're paying $110 for 1 call. And if it expires over 110, you're buying 100 shares of Apple at 110, right? So 100 shares of Apple 110 would be $11,000. And then your profit is going to be this minus this. Sorry, I messed up. So let's say Apple expires at 114, let's just say for example. That'll give us a good place to go. So your profit will be $100. I mean, this is how much you paid to buy the shares minus the premium that you paid. So that was your total cost, which we have here. And then your shares are going to be worth 100 times what it expired at. So that, and then this is your profit, this minus this. So in this trade, you make $510, but Apple had to go up 14%, for this is just for an example. So again, you're making $510 risking 110. This is if you exercise the option and everything. Just we're going over the fundamentals. We're not talking about just buying and selling premiums right now. This is just fundamentals of options, right? This is what happens on the buy side. Now, the person that sold that option to them, you would have to own 100 shares of Apple as collateral because you're giving up the right to sell 100 shares at 110, right? Does that make sense, kind of? So, um, this would be easier. We could have just done negative here. But anyways, we're gonna put pay, net, receive revenue. Okay, so on the sell side, we're going to receive 110 because it's all the opposite, right? So you're going to receive 110, and then you'll have to sell your shares, and you're going to receive that, which is going to net you $11,110. But on the sell side, you have an opportunity cost, right? Because if you could have held your if you held your 100 shares till 114 instead of selling this call, you would have made, let's see, 114 or 14 $11,400. Um, could have received, and then your opportunity cost would be this minus your net. So that's how much you lost out on if you sold this call and it went above your strike price, right? You would have lost down $290, which grand scheme of things, look at this risk to reward. You're risking half as much. And let's say it didn't expire at 110, you would have just collected $110. Um, does that kind of make sense, guys? It's really, really weird. If you guys have any questions like right now, please ask them because you have to understand the basics of calls and puts, buying and selling them to kind of understand this lesson. And I have the chat open as well on my other screen. Good. All right. So this is buying a call and then buying a put. And we're just going to go over expiring in the. Okay, actually, let's do this. So you see how this works. You see the cash flow. Now, if it expired at 109, let's say, if it expires at 109, you're gonna on this side, you're gonna buy this. So you're gonna pay this money for 110. It expires out of the money, so you don't get anything. Your revenue is minus $110. You're just gonna lose your premium, right? Does that make sense? Because just like any option, expiring worthless, you're not gonna get paid. Now, on this side of things, you're still gonna receive your $110 because of this. This is how much you pay, or how much you receive your credit, and then you make $110. So whenever you're selling options, you're just collecting premium and you're giving up the right to do something. Um, if you guys know what a covered call is, this would be very useful in that type of scenario. But like I said, it's almost a way of making passive income if you own the shares for a stock, selling calls. And then selling puts, it's the other way around. If you're buying puts, you're buying the right to sell your shares. And if you're selling puts, you're selling your right. You're gonna have to buy the shares at that strike price. So, um, like I recently had a Neo put that 100%. I had the Neo 8 put. It expired yesterday for 331. I think I paid like 56 cents per something, right? And this expired at max gain, so I got $56 per contract. But let's say Neo expires at $7. Then at expiration, I will buy 100 shares at 8. So I'll buy 800 shares, and then here, let's do minus $800. Then the stock will be worth $700, netting $100 loss. Well, no, actually not because we paid the premium, right? Collected premium. And then this would be your net right here. So you would lose $44, but then you would also own 100 shares of Neo, the stock. So you lose 44 bucks, then you can just go back and sell a call for $8 and collect, probably around 56 bucks again. And that's called a wheel strategy. You're just doing one big wheel around and around and around. So, are you guys getting it so far? Please give me like a yes or a no in the chat, or can you explain this or that? Because I really need feedback for this because, like I said, it's a lot to wrap your head around. Makes sense. Cool. Okay, awesome. So you guys get that part. Okay, awesome. Cool, cool, cool. Well, you guys got that fast. It took me forever to understand that whenever I first got into it. All right. So now we're gonna go into credit spreads. We just went over buying and selling naked calls and puts, right? Let's go into credit spreads. So there's two types of credit spreads. Um, well, let's back up just a little bit. Credit spreads are the type of option strategy that involves selling one option and buying another option with a different strike price. The goal of a credit spread is to generate income by collecting the premium from selling the option while limiting potential losses through the purchase of the second option. So there's two types of credit spreads, just like any other strategy. There's going to be bull credit spreads and bear credit spreads. Of course, bull credit spreads are used when you expect the stock to rise in price, while bear spreads are used when you expect it to fall in price. So how do credit spreads work? Let's say you want to trade a bullish credit spread on a stock that's currently trading at $100. Um, Trading at $100, you're gonna sell the call option um, with a strike price of 110, and then you buy the call option for 115. So you're gonna collect premium from selling the. You're gonna collect the premium for selling these two, the difference. So let's say this premium, since it's closer to the money, let's just say easy numbers. This is worth $100, and then you have to buy this one. So this is your claim. You're collecting this premium. Then you're gonna have to pay, let's just say $30 for this one. Why is this being weird? Oh my God, Excel. I like to work in dollars. So your net cost here is $70, right? Um, and basically this is gonna allow you to not have to have so much collateral. Because usually if you would just sell a stock at 110, you have to have 100 shares of that stock, which could be, over $10,000 for one trade for a potential, $70 profit, which is just absurd. So, for here, your collateral would be $500. So, collateral is always going to equal difference in strike price. So, in this case, it's going to be 110 to 115. So, 5, which equals $500 in collateral. That's how much you would have to have um, to execute this trade, right? So you're risking 500 bucks potentially to make 70 bucks, which might not seem like the best risk to reward, but hold on, we're going to get somewhere. So if the stock expires, I'm not really going to go over what happens if the stock expires between the two securities because it gets really weird and I don't really quite understand it honestly. That's why I don't really let them get that close. Um, but your real risk here is that you could lose up to $500 for a $70 profit. So you can lose more than 100% of your investment because your investment's going to look like it's just $70, but it's really 500. So let's see. Let's see. So you reach max gain under 110. So if the stock expires under 110, you get plus $70. If a stock expires over 115, you lose $500. But again, look at the trade, right? The stock's currently trading at $100. And this would be like a week, 2 weeks max out of the money. So you'd be risking $500, but the stock would have to move 10% for you to start losing any money. So if it expires between these two, you don't lose. You're not going to lose $500, but you are going to have a loss. And it's different for every stock. It depends on your delta and your theta and all that. But now that we're talking about deltas and thetas, um, if you buy options, your theta is what works against you a lot. So your theta decay, if the stock just trades flat, you're losing money if you buy the option. Um, so okay, gotcha. So you're losing money if you buy the option and the stock trades flat, or if it moves against you at all. It's hard for it to get back. So if you sell the option, theta is actually making you money. So we know most options, especially like short term 1 to 2 week options, are going to expire worthless. So I almost say it's like betting on the house, like it's a casino almost. If you can bet on the house, you can bet on the sellers. If you can bet on the side that has most potential profit and most or the higher accuracy rating, why wouldn't you? So if most options are going to expire worthless and theta can work in your favor, then why wouldn't you just sell options? Because let's say we buy this at 110 and it goes up to 109, but it just trades flat at 109, then if it trades flat at 109, you're gonna realize max profit. You know, um, so again, it's just in my mind, it was a no-brainer to start trading with this strategy because, like Trent just said in the chat, 90% of options expire worthless. And in my mind, like I just lost a trade. I had 100% loss on a trade, right? Because in these you can lose more than 100%, which is why risk management is so important. Because you have to set your stop losses. So for me, if I win 9 trades in a row, which I think it just had like a 14 trade win streak or something, um, where I had a few hundred percenters in there. But if I can win, 9 in a row, then lose one at 100%, I'm okay with that. If I size accordingly, like I should, like I know I should, then I'm totally okay with that because that's profitable. And all I want to do in the market is be profitable. Um, so again, it's all about your risk management. It's all about really how you want to trade. Like this strategy is not for everybody, but for me, I work at a wealth management firm. I I run 2 businesses. I travel a lot for those businesses. I can't sit at a desk and day trade every day. So this strategy is perfect for me because it's basically passive and you're just collecting premiums and it's pretty effortless the way you can do it. Um, because again, you buy it and you set your stop loss, you set your take profit at like I don't know, 0.02, 0.03, just so you can buy it back or let it expire worthless, either one. And you're just chilling pretty much. Now, a lot of people would do trade 0 day to expire credit spreads. And again, that kind of works in your favor, I guess, but it's super volatile and you can lose a lot of money really fast if you do that. That's why I prefer going, 1 to 3 weeks out max, just so I can collect more premium. But I do that more often just so I can, get a more passive outlook on it. Um, because again, I'm fine waiting 3 weeks if it's way out of the money. We can actually go to my chart really fast. Can you guys see this chart? I don't know if it brought
No, it
over.
didn't switch over. You're still on Excel. So
Okay,
just
cool.
to
Let me.
recap, you're putting up in that example 500 collateral to make a $70 profit, but which doesn't seem like a good risk to reward, but it's more guaranteed because like we explained, 90% of options expire worthless. So theta is working in your favor.
Correct. And that's why it's so fun. Um, I talk in other discords and stuff, obviously, and they're always in Max. They're like, Logan's taking our premiums, and I'm like, hey, you gave them to me, you know. Um, in my mind, it's almost like free money. Every trader's gonna have its losses, no matter what your strategy. But that's just it. Just seems so easy once you can wrap your head around all the logistics and actually buying it. It's super easy. So how can I
Right. I
switch?
remember just real quick note, like when I was first starting off, the notion of selling an option, like how do you sell something that you don't have? Right. So it's
Right.
like the terminology is confusing for new people, but it makes sense the way you explained it. Good job. Thank you.
Thank you. How can I switch over to
You just share a new window. So you got to
share new
click share
window?
screen again. Maybe stop your share and
Got it.
do it.
Cool. Did I do it?
Yep.
Awesome. Okay. So I'm going to recap a recent credit spread trade that I did do, just because you guys might find it beneficial. So I'm going to turn off all indicators because I don't really need them on here at all. So let me go on my other screen and figure out when exactly I made this trade. We're going to look at MasterCard. And I picked MasterCard in particular for this trade because recently banks have been failing, but MasterCard stayed fairly strong. It's had a $20 drop. It's a $350 stock. Not that big of a deal, in all honesty. About a 8%, 7% drop. But let me go check out this trade and see when I made it so I can really walk you guys through it, and show you my thought process the whole time. I think I made it last Friday. So that would be the 24th. Yep, here we go. 23rd. So on March 23rd, which would be right around here, right here. Um, let's see. I am gonna do some circles here. I bought a. Okay, looks like everything's gonna want to show up. I bought or I sold the 325 put, right? So I sold a put right here and bought the 310 put all the way down here, right? So I sold this put at 325. And at the time the stock was trading at 354. So um I put up $1,500 of collateral and I collected 49 bucks per contract, which again might seem like a stupid risk to reward, but the stock would have had to move, let's see, um, over 8% in a week. And in my mind, that's just, I mean, it's guaranteed unless MasterCard comes out with a huge scandal or something. So that was my trade. And like I said, I made $49 per contract. Again, I'm risking $1,500, but you could, sell the closer strike, make a little bit of less, but not risk as much, if that makes sense. But so my thought process for trades is let me get a super out of the money. Let me sell super out of the money options because again, they're most likely not going to expire worth anything. And that's what we saw yesterday. They expired at zero. I got 100% profit, and MasterCard actually went up. So it was perfect. It was a perfect situation for us because we didn't even get close to dropping at all, and we collected a lot of premium. So actually, Monday I might even look to sell a straddle, or not a straddle, an iron condor, where I'll sell the 370 call and sell the 340 call. So I just hope it expires between this range right here. I mean, that's a huge range. Asking it to expire anywhere in between here, and I'll make money. That's a strategy for a whole different day, but it's again, you're selling option is something you can do. But these premiums are really nice because Mastercards are really expensive stock, so you can collect decent premiums for 8 to 10% out of the money. Let's see. So that was a trade, and then let me see any other trade I want to go over really quick. Oh, a meta credit spread. I risked $500 for $28. That expired worthless as well. The Microsoft one had a max loss of 100%. Um, that's really all the trades I've made in the past week. It's been a pretty weird week. I haven't really want to bet against this weird trend we've had on SPY here because we took the elevator upstairs, it looks like today. Um, but yeah. Also the way that I trade by hedging out an equities portfolio. I mean, obviously you guys don't have to do that, but it's just what I personally do to help myself help myself. Um, let's see. Could you do a month out too? Yeah, I mean, you could always do however far out you want with the contracts. Um, I love having theta on my side, and if you're trading a month out, you might not have theta on your side as much as you think, um, because you might be collecting like $1 or $2 a day from theta, as opposed to 2 weeks out, you might collect $6 to $8 a day sometimes. But yeah, you could go a month out with the contracts if you wanted to. You could also, like I said, do 0 day to expire if you really wanted to. But yes, you could definitely go a month out. Thanks for asking. Let me see. I'm trying to think. Do you guys have any more questions in particular? I feel like I covered it pretty fast, but that's really a strategy that I do. Oh, I was saying I hedge out an equities portfolio. So let's say you have a $50,000 portfolio, which is, pretty sizable, but I'm just using it for the ease of numbers. A $50,000 portfolio and you invest 10% of it. So let's say you invest 5 grand into equities. You have 45 grand left to hedge. And you could hedge that using, you could sell spreads. For example, in my IRA, my retirement account, I own hundreds of shares of things and I sell calls. I sell the option to collect the premium. And worst case scenario, I sell my stock at a profit. I'm very happy with that. But again, different strategy for a different day. Today we were going over credit spreads. Yep, exactly. A covered call. That's exactly right. And all you're doing here is selling a covered call that's not covered. Um, okay, actually, that's a great way to explain this. So let's say you're selling a credit spread. You're selling a covered call, but your coverage is the debit that you pay for the option that you buy. So you're basically selling 100 shares and buying 100 shares at the same time at different strike prices. So that's how you're making the money and putting up less collateral because you're covered in both directions. Let's see. You guys have any questions or anything you want me to kind of go over again? Trent, anything? Oh, there we go. Some
There you
questions.
go.
Can you explain more about the risk and potential rewards of credit spreads trading? What are some common mistakes that traders make when employing credit spreads? How do you determine the optimal strike price for credit spread
You
options
can do one of
trade?
them, all of them. Feel free.
Hey man, we'll do all of them. Why not? So let's go over the risk and potential rewards of it first because that's kind of the kicker. 1 second. All right, let's see. So credit spreads offer traders the potential to profit from selling options while also limiting their risk exposure. However, like any trading, there's pretty big risk involved, especially when you're trading levered derivatives like options. Let's see. You use ChatGPT to make up some questions. Gotcha, man.
Hell yeah.
Um, so the main risk of trading credit spreads is the potential for the stock to move against the trade, causing your losses, and market volatility. Especially what we're seeing right now with the Fed and stuff. You know, if you can't look at the SPY chart, you can tell it's pretty freaking volatile. Um, we had a good range right here that we just kind of bounced up and around 5%, which is fairly comfortable over a week or so. But then we rocketed like, what is this? 4% in 3 days. So it's just like, this is very volatile. So it's really hard to predict the market, just like any other trading strategy. So the potential rewards of um, trading credit spreads is the ability to, like I said, generate income through selling the options and limit losses by buying that debit. So you don't have to put up as much collateral for the trade. So that's one of the pros and the potential rewards of trading the credit spread side of things. Also, option premiums can be really pumped up during times of volatility like today. So, for example, look at something like Bed Bath and Beyond, right? Bed Bath and Beyond is going insane. It's a meme stock. It moves like crazy. I mean, you could sell calls and puts on this thing for you could generate a lot of money. Like I think if you're selling calls right now, you can collect up $60 per call and max loss be like $40 because you're only paying $100 for the stock. And then if you get assigned, you can just go and wheel the option and just keep buying and selling calls. So look for stocks with higher implied volatility to kind of pump up the premiums. And like I said, potential losses, you can potentially lose more than you can lose more than 100% of your investment. You know, you can only lose up to your collateral when you're trading the spreads. If you're trading naked, you could lose more than what you put in. But if you're trading these spreads, you can only lose up to your collateral. That's another kind of pro and con of trading spreads is you can lose some more than you would like, but you can also limit that risk. So let me just go back to SPY. I don't like looking at that. All right, let's see. What was your second question? What are some common mistakes that traders make when implementing credit spread option strategies? So I think the main one is not managing your risk properly. The most common mistake is not managing your risk properly because you might go into it your very first time and be like, "Oh, I'm going to sell 10 spreads so I can make, you know, $400." Or you could just sell one and make $40, especially when you're just learning. I would always say start sizing small in the beginning so that way you can really understand the way it trades and the way you can make money and lose money. So I think that's probably the most common mistake. The other one is not properly selecting strike prices, which is kind of what you went into in your third question. So people need to consider the volatility of the market again, and as well as the premium they're going to collect from that volatility. So um, again, if you want to select a further out strike, you're going to be a lot safer, but you're not going to collect as much premium, which personally I'm okay with. I'd rather go for the safe trade, but some people are not in that mindset. Thirdly, we'll kind of go over that again. Determining the optimal strike prices for credit spreads. It's really all about volatility again. Like I said, the further out you go, the safer. You're not going to collect as much money. I like to go. Let's say I'm going a week out, right? Um, let's go to Microsoft. Let's say I'm going a week out here, and we're actually approaching a mental level of 300. I just did this personally with Nvidia. Let's go to Nvidia. It's a perfect example. So right now I've sold $300 calls and bought like the 310 or something. So I sold them like way back here. Um, right here, probably around here, March. No, not March 16th. I definitely sold them early this week. Let's see. Let's just say I sold them right here, right? And then we have to go to 300. So that's a 13% move in 2 weeks because I bought them. They're expiring next Friday. And Nvidia's experienced some recent volatility, a lot of recent volatility. Big drops, big pumps, stuff like that. So with that volatility, I'm trying to capitalize off of it because the option premiums are pumped up. It's way out of the money. It's a mental wall of 300. There's just a lot of things going for me in this situation. So I sold them, I think, for like over $100 a contract, even though it was so far out of the money. And I'm already up, I think, like 60% just because we traded like a little bit flat. I mean, Nvidia's gone up, but by the time I bought them and by Friday, the fade has eaten the options so far, so deeply because it's so far out of the money that I've been able to profit off of it. And that's why I like to sell options. So that's how I kind of choose the strike price and really the stock in general because you're going to want to trade them on somewhat volatile assets, but not so volatile that you could lose easily, if that makes sense, you know. Let's see. That's really all I have for you guys, unless you guys have any questions. And like I said, I'm more than happy to answer them.
Thanks, Logan. Make
Yeah,
sure
for
if you
sure.
guys got any questions, ask them right now.
I'm all ears, guys.
So yeah, that was a great lesson.
um, Wani said you're up Nvidia 60% on Nvidia in 1 week. Let me actually check my let me check my phone really quick. So Nvidia expires 4/6. It's the 300/310 call. I'm up 73%. So it's not, I didn't collect as much credit as I thought. Um, so I sold the 300 call, bought the 310 call, and I collected $45 of credit, and it's currently sitting at $12. So even it was up on Friday, and I still made 33%. So it's very nice, you know. And I might even look to sell more for another week or two out on Monday and alert the trade because I don't see us maintaining this little bull run on the market for very long term. That's the other thing. Whenever you don't really know what the way the market's going, you can select really far out of the way, really far out of the money credit spreads. And I don't want to say guarantee yourself income because nothing's ever guaranteed in the market, but you can increase your chances of profiting a lot in choppy environments. So let's see. Any more questions, guys? All right. I think we're good. Well, thank you guys for having me on here and thanks for showing up on a Saturday. I know it's not the most convenient day to show up, but if you guys have any questions, oh wait, Wani, are you unmuted? You were trying to say something?
No, no, I just wanted to say thank you.
Oh, thanks. Yeah. So thank you guys for showing up on a Saturday and like taking the time out of your weekend to come learn and investing into yourself. Um, I appreciate it. I know Trent appreciates it. And if you guys have any questions about how to get approved for credit spreads, because you have to have margin, level 3 margin to get approved, shoot me a message and I'm more than happy to help you guys out. If you need suggestions on brokers, I'm more than happy to help you guys out. But yeah, if you guys have any questions about credit spreads or anything, feel free to message me. Don't tag me in the chat because I have a lot of discords and I'm not always looking at all the chats. But like I said, feel free to DM me and I'll definitely get back to you guys.
Awesome. Thanks, Logan.
Yeah, thank you guys. Hope you guys have a great weekend.
Yeah. Have a great weekend, everybody.